So the question I'm asked most often by traders is, what mentality do professional traders have that sets them apart from how everyone else thinks about the market? And the answer to that question is actually pretty simple once you think about it. Now, the majority of successful traders are pretty logical and math-oriented, so the answer to the question of how do they think about the markets comes from a statistical background. The way that professional traders think about trading and evaluate their trades is in terms of expected value. Simply put, expected value is your average expected return every time you play a game or place a trade or play a hand of blackjack. What is your average expected return given the rules and parameters of a game? And there is actually a simple equation we can use to find out the expected value of any game of chance. So expected value, EV, is equal to the probability of you winning multiplied by what you get if you win. And then we subtract the probability of you losing multiplied by what you lose if you were to lose. Now, when we fill out the variables for this equation, we are going to get an answer, and it's going to be a numerical answer. Whether that number is positive or not is extremely important, because if the number is positive, it means that the game we are playing has a positive expected return for us, meaning that in the long run, we are expected to make money or come out ahead by playing this game. Now, if our answer to this equation is actually negative, we are not expected to win in the long run. So let's do a quick example here to show you. Let's say that we were playing blackjack and we were the casino. I'm the dealer at a blackjack table. What is my expected value for every single game of blackjack I play where the bet from the gambler is $10? Well, let's fill it out and have a look. So as the casino, my probability of winning any game of blackjack is 51%. So 0.51. And if I win, I get to keep the gambler's $10. Now, since I have a 51% chance of winning, that means my odds of losing are 49%. So 0.49. And if I lose, right, the gambler bet $10, I'm going to have to pay out $10. So if we do this equation, here's what we find. We have $5.10 minus $4.90, which equals 20 cents. What this tells us is that on average, a casino makes 20 cents per hand of blackjack that they play where the bet is $10. So what is the significance of this number for the casino? Well, let's break it down. If someone were to come in and play one hand of blackjack, what could happen? Well, think about it. It's 49 and 51% chance. So realistically, it's basically 50-50. So the gambler could come in, place a bet, and there's a good chance that they would walk away with the win. It would be 50-50 basically. So what we can take from that is a small advantage, the 51%, isn't a huge help over a small number of hands. But what happens when that gambler sits at the table for a lot longer, maybe plays 100 hands? What starts to happen? Well, all of a sudden, this small advantage that they have over the 49% that the gambler has becomes a very significant factor. Over a large number of plays, the expected value starts to show itself. There's a reason why gamblers always end up saying, I should have walked away then. And a reason why casinos don't have clocks in them. Do what they can to keep you at the table. It's because they understand that in every game you can play at the casino, they have the positive expected value. And since they have that, they know that the longer you play, the more hands you play, the better the chance of them taking your money. So to bring this back to trading, any trade that we place has a large luck element. And it's for that reason that we don't want to go all in on any single trade individually. The way professionals look at trading is they try to calculate the expected value of their trade. And then they try to spread their bets across enough trades that this expected value starts to show itself. So think about this situation, right? If the casino had a bankroll of, let's say, $100, right? The casino has a bankroll of $100, and they let a gambler come in and bet $100 at one time, there is literally a 50-50 chance that the casino goes broke. So if the bankroll of the casino was $100, they may limit the size of bet you can place to 25 cents, right? You notice how when you go to a blackjack table, there's a maximum you can bet at the table? The reason for that is that if they let you bet too much at once, it actually creates a chance that you could win the game against the casino. The best way to play a hand of blackjack would actually be to come in and bet your whole bankroll on the first play. Because the more times you sit at that table and play games, the more likely that the expected value in favor of the casino is going to start to show itself. So how do we determine if we have a positive expected value in our trades? Well, it comes from one thing and one thing only, and that is having an edge. This is the most important thing in trading. When we are competing in a zero-sum game, a game where the person on the other side of the trade loses $1 for every dollar we make, and we lose $1 for every dollar they make, we need to have some sort of edge over the competition if we want to be winning in the long run. When we can determine our edge, prove that it's there, we can go into that trade every time we know it's there, knowing that we have a positive expected value for the trade we're going in. When we can determine that this is the case, all that's left to do is manage our risk adequately enough that the edge starts to show itself before we blow up. And this is the mentality that we need to have if we want to win as traders. We need to be able to go into our trades knowing that we're supposed to win on average, knowing that it's driven by an advantage we actually have over the person on the other side, right? This could be a structural advantage, it could be an information advantage. There's lots of different ways that you can determine an edge, but we need to know that we have it before we go into a trade. Otherwise, we don't know if we're the 49 or the 51, and we want to be trading when we're the 51. So there you have it, the mentality that we need to have going into trading. If we can go in with this expected value mentality, we come out the other side as winners as long as we manage our portfolios with a degree of professionalism. To start trading like professionals, we first got to start thinking like professionals. And this is the mentality that they bring every time they come into this game.